Peter, the Fed laid out 3 reasons for why it cut in the release of the minutes yesterday. The phrase I'm fixating on, and I think a lot of people fixated on, is risk management. What does that mean to you? What does that mean to investors? Because it sounds like it can encompass anything you want.
Yes, I think it's deliberately sort of loose phrase. I mean, there clearly are risks out there that are being reflected in markets, and that's gone some way to tighten financial conditions, and the Fed and other central banks are clearly very focused on financial conditions. And the breadth of the risks really run from everything to do with the weakness in global growth, and particularly in the industrial sector, the fallout that we could get from further from the trade tariffs and trade war. And of course, there are a number of geopolitical risks out there which are raising levels of uncertainty, having an impact on investment decisions. So I think that there are clearly many risks that investors are facing. Some of them are economic, some of them are geopolitical. They're difficult really to measure or model in many cases, and that's, I think, really what they're pointing to. And
that's a backdrop for why Chair Powell said that the rate cut last time was a mid-cycle adjustment. Now, in looking at that mid-cycle adjustment, is it necessarily fuzzy, that phrasing as well? Is it a case of we'll know when to stop cutting when we see it, or is it quantifiable in any way?
Well, I think it is an important point to emphasize that in their view, and indeed in our view, this is not cutting because we're seeing the end of the economic cycle and a recession is imminent. Now, clearly, financial markets have worried about some of the signals that we're seeing out there, the inverted yield curve as an example, the weakness in PMIs and industrial data in particular. But it's important to also emphasize that if you look at the US in particular, the household sector remains in a strong position. You have very low unemployment, wages are rising a bit. The savings rate, importantly, is well above the long-run average. So you don't have big imbalances in the household sector, such as we've seen before other recessions. And in that sense, I think what they're really emphasizing here is that there is a slowdown in global growth, particularly in the manufacturing sector. This doesn't really mean the end of the overall economic cycle, but to reflect that weakness and low inflation, they're prepared to ease policy a bit.